Hi, this is Forrest Bell, President and Senior Investment Advisor of Bell Investment Advisors. I want to welcome you today to our webinar, How Likely is a U.S. Recession? I'm happy to be joined by my colleague and portfolio manager, Ryan Kelley. Welcome, Ryan.
Thanks, Forrest.
We're going to be answering 4 questions on our webinar today. What is the definition of a recession? How do recessions occur? What do the current economic data suggest? And how does the stock market respond to a recession? Ryan, will you start us with the first question?
Sure, thanks, Forrest. So since the topic of this webinar is about recessions, it probably makes sense to start out with defining what they are. So you may have read, this is a pretty common definition in the financial news, that a recession is 2 quarters of economic decline or negative GDP growth. But actually, a recession is defined by the National Bureau of Economic Research. So whatever they declare is the start and stop of recession, that's what it is. It's actually not based off of GDP growth, although that is a factor they look at heavily. So I'm going to read the definition for you right now. So this is their official quote of how they define a recession. So it's a significant decline in economic activity spread across the economy, which lasts more than a few months, which is normally visible in real GDP, real income, employment, industrial production, and wholesale retail sales. Now you'll notice that there's some subjectiveness to that, whereas the 2-quarter of economic decline definition is objective. So I think that's part of the reason people while not official, it's an unofficial definition, persists, as well as the fact that you can apply that across different countries without having to rely on some local organization that's declaring start and stop dates to recessions. So moving on. The last recession that the National Bureau of Economic Research declared, so the last one that we've experienced in this country, officially it started on December 2007 and ended June 2009. But what's interesting is you didn't know that real time. These declarations came much farther after the fact. So it wasn't announced that the recession had begun until December 1st, 2008, so about a 12-month delay from the start of the last recession. And they didn't declare the recession had ended until September 10th, 2010, so again, about a 15-month delay. That means that while you're in a recession, you really don't have any official confirmation that it's begun or that it's ended. And just as an interesting aside, if you had tried to time the stock market based off when this organization was declaring the recession began or ended, you actually would have missed out on a 34% gain as measured by the Russell 3000 index. Because by the time they announced the recession had started, it was pretty obvious to everyone and the market had already gone down quite a bit. And by the time they announced it had ended, the market had bottomed in March of 2009. So there had been many months, actually well over a year of market gains before this announcement even came out. So how do recessions occur? This is also called the business cycle. And it's something that different economists study, and there's different schools of economics, and they all have different theories on why business cycles occur, if it's possible to moderate or even stop them. So I'll just give you some common explanations. This is by no means comprehensive. So excessive borrowing, speculation, and bad investment is one possible cause of recession. If some of you may remember the savings and loan crisis that hit in the late 80s, early 90s, and there was a recession tied to that. The last recession we had clearly was a lot of all of this: speculation, excessive borrowing, leverage, bad investment, specifically tied to the housing sector of the United States. Second point is stability breeds instability. Now this sounds very similar to the first point because what it's saying is as things are stable, the longer they're stable, things actually become more unstable or more fragile to some type of shock rippling through the system and causing a recession. So I'll give you a sort of analogy. I just watched a video of an earthquake that occurred in South America, in actually Chile, and it was a 6.8 magnitude earthquake. Now in the video, it's showing, I believe it's an airport terminal while the earthquake is occurring, and no one even bothers getting out of their seats. They're so used to earthquakes, they happen all the time. Their building codes and standards are very robust. Because they've been tested so many times by these earthquakes, no one really panics. And I'll contrast that to an earthquake that happened in this country in 2011. I believe it was a 5.4 earthquake that hit the Washington, D.C. area. And there was actually damage. There was people kind of freaking out because they're not used to earthquakes. And so their building standards, just their psyche isn't really adapted to having these earthquakes. They're just so uncommon. So to give you a specific economic example of this, again, I'll go back to the last recession, where prior to that occurring, housing prices had been going up, 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 up. And you didn't really have a period in the United States going back, at least going back to the Great Depression, where housing prices across the country fell by any meaningful amount all at once. You may have had regional declines, but nothing on a national base. And so people are kind of complacent. A lot of the credit rating agencies didn't really account for that possibility in some of their models when they rated certain bonds, and people were just borrowing tons because, you know, hey, housing only goes up, can only go in one direction, so why not? And of course, we know this led to a lot of excesses and ultimately created its own feedback loop and ended up doing a lot of economic damage. Another point that's frequently tied to recessions are resource shocks, and I'll talk about one specifically that's very common, is oil price spikes. So we've actually had 4 recessions that I'll talk about, 1973, 1979, 1990, and the last recession that started in 2007. They all accompanied oil price spikes. So this is a very common, at least occurrence, if not cause of recession. And so actually these 3 points I just went over, they all occurred in the last recession, and that's probably why it was so severe relative to previous recessions we've had in this country, is that you kind of had a triple whammy at least of factors that were all impacting the economy at once, kind of just led to a pretty severe recession by historical standards. Just a few other possible causes of recessions. So technological disruption, you may have read recently about artificial intelligence or robots replacing people's jobs. This idea actually goes back to the Industrial Revolution, where there was fear that when we back then previously had a really farming-based economy and most employment was in agriculture, that as new techniques developed where things became more efficient and the human labor need to create food went down, that the people that were displaced by this new technology would actually, they wouldn't be able to find other jobs fast enough, and you could actually have a recession because of this. Certainly political factors can cause recessions. Changes in taxation or spending policies can create shocks to the economy and cause recessions. Environmental regulations possibly could at least cause regional recessions. But finally, probably the big one, we read it so much in the news almost every single day, is the trade war that's been going on. That certainly has been creating some economic stress at the margins, at least. And then finally, one interesting point is just falling confidence in and of itself can create a recession, or at least make it worse. So if there's enough pessimism in the economy, it creates kind of a negative feedback loop on itself. You can imagine if you owned a business and the outlook didn't look so great, just general pessimistic attitude, you may decide to delay hiring, to delay expansion, to delay purchase of new machinery. Consumers may decide to delay big ticket items like purchasing a house or a car. And these sort of negative feedback loops and falling confidence and pessimism can definitely either spark or worsen a recession. So with that, let me turn things back over to Forrest, and he's going to discuss some of the current economic data that we're seeing right now.
Thanks, Ryan. So what are economic conditions today? If you have read any of our recent publications, you know that current economic data is more favorable than not. We are currently experiencing low unemployment, very low unemployment actually, rising wages, low inflation, and healthy consumer spending. But before speaking to those, let's talk about some of the unfavorable data. As Ryan mentioned, the trade war is having an impact. It makes business planning difficult, tariffs do. And when faced with the prospect or the threat of new tariffs, business owners are a little more reluctant to hire. So most economists say this has cost the US economy jobs. Moody's Analytics puts that number at 300,000. And tariffs themselves do place a drag on gross domestic product. The CBO estimates that 0.3%, a 0.3% reduction in GDP due to tariffs. That number may seem small, but with GDP running along at about 2%, that represents 15% of potential growth, a significant number. Some context here is helpful. This is a chart of real GDP dating back to 2015, and you will notice that some quarters are stronger than others, but they are all positive, including the quarters where tariffs were having an impact. So do tariffs create a drag on gross domestic product? Yes, they do. Does that drag outweigh the broader economic strength that we see today? No, they do not. Corporate earnings could also be stronger this year. They're actually down slightly through this year, or at least through the second quarter. This is a curiosity in the sense that those same US corporations are showing an increase in gross income of about 4% this year. So how do you find yourself in an environment where gross income is going up but earnings are declining? That occurs when the rise in the cost of doing business is faster than the rise in gross income. So what is that owing to today? Is it owing to tariffs? Is that owing to just the organic rise in the cost of materials that occurs with or without tariffs? And what part of those rising expenses is owing to labor costs? Admittedly, this is difficult to untangle. I mentioned rising wages. They are up nicely year over year, over 3%. Viewed from the perspective of corporate earnings, that is not such a good thing, but from a broader context, it's a positive. If you imagine workers having more income, more financial flexibility, more financial capacity to buy the goods and services they want, that's a positive. Remember, 70% of the US economy is consumer spending, so this is a material dynamic. Unemployment rate continues to be very low. Unemployment hasn't been this low since 1969. And the US did add jobs in August, over 130,000. 25,000 of that 130,000 are temporary, related to the 2020 census work, but the US economy did add more permanent jobs in August. Consumer spending was remarkable through the second quarter of this year, up over 4%, the fastest quarterly increase in nearly 5 years. And inflation is still trending very low. For some perspective, the 100-year average of inflation is 3.1%. So to be trending along at 1.8% means that the cost of goods and services is not soaring out of reach. So what does all this mean? In July, 226 economists were surveyed, and they put the probability of a recession in 2019 at 2%. So exceedingly low odds that a recession would occur in 2019. Looking out over the next year, the New York Federal Reserve put the odds of a recession at 38%, still pretty low. So looking at this year and next, the odds are against an inflation, a recession occurring. Let's now discuss how recessions impact the stock market when they do come. Ryan?
Thanks, Forrest. So what's interesting about the stock market relative to the actual economy is it tends to be forward-looking. So typically it starts declining about 6 months ahead of the economic cycle peaking, and it also starts rising 6 months ahead of the economic cycle bottoming. So what that means is the economy is actually still expanding. Meanwhile, the stock market has peaked and starts declining, and vice versa. When the economy is still contracting, the market's already looking ahead and thinking, hey, this recession, yeah, it's still going, but we're almost through it, and it'll start rising. That means it's pretty hard to time things using economic signals with the stock market. As well as you get a lot of false moves, you get market corrections, you can get false rallies in the middle of a bear market. And the reason for this is that market participants, again, they're forward-looking, they try to anticipate changes, and they're doing that with incomplete data. So as new data comes in, they kind of adjust their opinions, and that's why the market can be so all over the place and false signals, and that just makes it extremely difficult to try to forecast because the market's constantly evaluating new data, and it can be a bit spastic. I want to show, I show on the next slide a chart, but just one final point. So the stock market, I mentioned it bottomed in March 2009. The recession actually ended in June 2009, and we haven't had one since. We've actually had decent market declines in both 2011 and 2015 of over 10%, and yet we haven't had a recession at all. So this is just ideas of these corrections when markets are trying to, well, maybe the economy's softening, but ultimately nothing happens, and it's just a false signal, and then the market continues on with its bull cycle. So here's an example of an actual market event. I don't have the dates on here, just to keep it a bit of a mystery. But I'll give you some context. You can see obviously what's around this to 20% decline, peak to trough. The background economic data for this moment in time was pretty positive, but some new negative news developments had come out. So everyone was wondering, is this recession? Is the market signaling a recession? But the problem is in real time, we don't know. So on the next page, let's see what actually happened. So now with the axis filled in, you can see this is actually showing the period starting from last year, the end of last year, going through just a few days ago. And you can see if you had sold at kind of the bear market point, which is commonly thought of as a 20% peak to trough decline, you actually would have missed out on quite a lot of gains in the stock market. And I just put this as an example of how difficult it is to try to use either market signals or economic news as a way to forecast or market time your investments. So with that, let me turn things back over to Forrest, and he can go over some of our webinar conclusions.
Thanks, Ryan. So a couple of conclusions. Trying to guess the start of the next recession to avoid investment loss is potentially harmful. As Ryan explained, by the time a recession is official, the information isn't terribly helpful. And even if you had real-time data to show you exactly the day when a recession formed, the mark where 2 consecutive quarters of contraction had occurred, the average recession is mostly over by that point. And because the market is forward-looking, it's already usually improving. The careful listener might ask, well, if recessions are not good for timing the market, maybe I can use market volatility as a better indicator. And as Ryan's last slides prove, that is equally perilous. There are so many false signals with market volatility that you would literally be chiming in and out of the market virtually every year. Since World War II, on average, the market experiences 14% drop per year, and that is a lot of noise to be following. So if you can't use recessions to avoid investment loss, what can you do? Well, you can have your risk tolerance reassessed. Every investment strategy requires discipline to succeed, and having an investment strategy that sits within your risk tolerance really will help you stay consistent and disciplined over time. Now is a great time to have your risk tolerance reassessed. This is better done before recessions than during them, because during them, at that point, you probably just want to wait for the recovery to occur. In the coming weeks, a recording of this webinar will be available to view or share on our website. And if you want to share it with friends or family or colleagues who have concerns about the market, please do so. This is a look at our past webinars and our webinar library. Our next webinar is scheduled for November. We will post the topic and the date on our website and send the information to everyone who receives our email newsletter. Speaking of our email newsletter, it's a great way to stay in touch with us along with the resources on our website. You can subscribe to our email newsletter by going to www.bellinvest.com/subscribe. Thanks again for joining us today. Thanks, Ryan.
Thank you, Forrest.